that when 2008 crashed, when Lehman Brothers crashed and Bear Stearns crashed in 2008, the Fed acted quickly and they lowered rates, interest rates, which allowed you to maneuver. And I think today, by comparison, they're not doing that. The Fed is trying to keep rates high to fight inflation. I think a lot of real estate investors are probably experiencing challenges because we're all used to 3% financing, and now it's I don't even know where it is.
This is the Real Estate Vibe Show, and I'm your host, Loomba, a commercial real estate investor. And today I have a very special guest, my good friend, Mark Hunterman, with me. Welcome, Mark, to the Real Estate Vibe Show.
Thank you, Vinky. I'm excited to be on your show.
Me too. I can't wait. Okay, here a little bit about Mark. He's an entrepreneur, investor, and a founder of Quantum Capital, a multifamily syndication firm. He's also an Emmy-nominated writer, producer, voice actor, and original writer on Family Guy. Oh my God, I need to talk about that. That's super awesome. Today, we'll be discussing today's market trends versus 2008. So Mark, before we start digging into the current market trends, can you tell us a little bit about yourself, who you are, and how did you become who you are today?
Sure. I grew up in Ohio, and I was kind of a head in the clouds kid. In high school, I always liked to draw. And I got hired in high school to be a caricature artist at SeaWorld in Ohio. Believe it or not, there's a SeaWorld in Ohio. There was. I got struck by lightning while I was drawing caricatures there. But after college, I wasn't really sure what I was going to do. But I drew a lot of cartoons and did some writing, and I got hired by American Greetings, if you're familiar with that greeting card company. Uh-huh. Uh-huh. And I was in a new department called the Alternative Humor Department. That was kind of an experimental department. It was during the 90s. And if you remember the 90s, everything was like hip and counterculture. And so American Greetings was trying to capture that Gen X market. And so we could kind of do whatever we wanted. So we just tried to make ourselves laugh with all these weird cards. And the reality is nobody bought our cards. We were like a bunch of 20 somethings and making these weird cards, surreal. But the average greeting card buyer was what I learned while I was there is like maybe a 64-year-old grandmother, and none of them ever bought our cards. But those weird cards that I made got me hired to write for David Letterman in New York. And nice. So I moved up to New York City to write on The Late Show. Mm-hmm. And then I moved out to LA because I realized most of the entertainment business was out there. And I got to LA and I got a meeting. I had arrived in LA, and my agent who was there, my new agent, said, I'm the one who told you to come out here, but you just missed the staffing season. There's no jobs. All the shows are filled up. And so I was like, oh, well, that's great timing. I'm broke and I just moved across the country. Mm-hmm. But she goes, but you have all these drawings and these cartoons. So I'm going to call you an animator, and I'll get you a couple of meetings. I'll see if I can get you some meetings with, now that everything is in production. And so I got a meeting at Fox because they were doing The Simpsons. And I had a good meeting with these executives, and they said, we like your material, but we have no shows. But why don't you should go meet this young guy who's just starting a new show. And I'm like, sure, whatever. I got plenty of free time on my hands. So I met with Seth MacFarlane when he was like 20 years old. He just graduated from Rhode Island School of Design. And he showed me his like his animated short for Family Guy. And he said, you should come write on this show. And I was like, okay, I could use a job. And I took home this little short of that. And I watched it that night and I was like, I don't think this show's going anywhere. And so I got hired and I used my first script payments. I'm like, I'm in this giant city, Los Angeles, that I'm not familiar with. And so I used my first script payments on Family Guy to buy a duplex. And because I needed a way to survive in this new business. So that kind of kicked it off. I've been working on Family Guy more or less ever since. I've created a couple shows, written a couple movies, but mostly been on Family Guy, where I've been an executive producer and voice actor. Sometimes they have me do quite a bit of brain damaged characters, and I'm not sure why I get picked for those. But yeah, that's it. And I went all in on real estate back from the beginning. I loved it, and I did really well, like in the late '90s when I just moved out there, and just currently have a company called Quantum Capital. We've been going for a decade at this point, and it's great. It's fun. I try to balance both of my worlds, my writing and also the real estate. And I kind of feel like my real estate's going to be what I'm going to be, still be doing when I'm 90.
Yeah, when you retire, right? Finally.
Yeah, right.
But let me ask you this question. So when was the turning point for you that you feel like, oh, I need to do real estate? Because you were like big time in real estate.
Yeah.
So did it from the first duplex, did you have the enough knowledge to start in real estate, or how did that whole thing started? That's what I wanted to know.
Yeah, I was looking for some way to survive because I didn't really trust the entertainment business. I didn't think I'd be steadily employed. So I remember meeting a woman named Junon. This is back in like 1998. And she said, she asked me if I was renting an apartment, a 1-bedroom apartment at the time. And she's like, you're in the entertainment business. You're making some good money now. You should put it towards a mortgage. And I remember telling her, like, there's no way I want the burden and the responsibility of a mortgage, because I could be unemployed in the next couple of weeks. And she goes, no, but it's still, you're in a good market, and, prices go up. It's a good investment. And I told her, I said, if you could find me something that will give me stability so that I could sleep better at night, I'll do it. And so she kind of mentored me, and she coached me with this first deal. And it was listed at $365,000 back in 1998. And I won a bidding war with like 15 buyers, and I paid $435,000. So about $70,000, $65,000 over asking. And I thought I made a huge mistake. I thought I just screwed up and I was going to go bankrupt, but I stuck with it. I tried to learn how to operate it. And 5 years later, just to get at the point, 5 years later, I sold it for $1.27 million. And I realized, I thought like, oh, I have to do this all the time. This is all of my money is going into real estate. And it kind of created a virtuous cycle, because from that moment forward, I never cared about a car. Like I don't need a nice car. I wanted to put all my money into real estate and learn everything I could about it. And more or less I did that.
So what are the current market trends for the real estate investing now? I mean, it has been evolved over the years. There's no comparison between 90s and now. So if you can talk about that.
Right, right. Yeah, well, we went through a lot during that time, and every time there's some drama in the economy, it's a nice, it's another notch in your belt. Like I remember we went through my first adverse situation was the .com bust of like 2000,
2000.
and then there was 9/11, and then there was the Iraq War. And then that was 2008. And then we went through the Great Recession, learned a ton there, saw what happened and saw how things shift and change. And then, came out of that and through the teens and COVID and there's a lot of different different economies and you think what's coming. And sometimes you've got a whole new situation. And I think today is in a lot of ways a new situation. If I were to compare today with the Great Recession, which was it's always cited as along with the Great Depression, it's the big event that was very adverse and difficult for our whole country. Mm-hmm. But in a lot of ways, I think today with the high interest rates and inflation, I think for real estate investors specifically, in a lot of ways, it's harder than 2008. In 2008, the Fed lowered. There was a lot of problems with the economy, but when 2008 crashed, when Lehman Brothers crashed and Bear Stearns crashed in 2008. The Fed acted quickly and they lowered interest rates, which allowed you to maneuver. And I think today, by comparison, they're not doing that. The Fed is trying to keep rates high to fight inflation. And I think a lot of real estate investors are probably experiencing challenges because we're all used to 3% financing, and now it's I don't even know where it is. It's 5.5, 6.5.
I think even more for some of them. I have seen that even higher interest rate. But the thing is, interest rate being so high, and then we have kind of similar situations like the Lehman Brothers, in 2008, like the Silicon Valley Bank and the other bank, going belly up. So what is your perspective on that? How do you see the market now compared to kind of similar scenario, but not similar at the same time?
Yeah, it's reminiscent of 2008 that we're seeing the collapse of these giant institutions that you thought would never go down. But it's a symptom of what we're all dealing with. It's the high interest rates, and I get it. The Fed wants to fight inflation because high inflation does a lot of damage to the overall economy. But fighting that inflation by boosting interest rates up to 7%, you've got a lot of real estate owners that are upside down. That they don't, the income that they have from their properties does not cover the mortgage with those kind of rates.
Yeah, but what's going to happen, if you have a crystal ball to see, not this year, maybe next year in 2024 or 2025, and all the bridge is going to come towards the end, right? For the tail of a lot of people this year too, maybe towards the end of the year. So what is going to look like at that point for some of the operators? Yeah, there's going to be a lot of opportunity for people to get into these kind of deals, but at the same time, people are going to be losing their shirts as well.
Yeah. I think like obviously you're in the same world that I'm in, and there's a lot of operators that there's a lot of syndicators and a lot of new syndicators. It's probably grown. The syndication world has expanded dramatically over the last 6 years or so. And I think, and kind of the ironic or sort of maybe cruelly funny or darkly funny is is it's such a social media driven world. And I think now for the last 10 years, like syndicators just go out and tout their triumphs and their success and how great they're doing because they're all raising money. But I think there's probably a lot of silent screams right now amongst operators because a lot of them are stuck and you know whether it's their I don't know that it's necessarily their fault. It's just their they got caught in this situation, the economic situation we're in right now. And yeah, I feel for them. It's a hard lesson that you got to be conservative with your leverage and be careful.
That's true. And plus COVID-19 pandemic has played a big role as well, right? What shifts have you seen in your area where you're investing in your markets?
Oh,
Yeah.
You may be familiar. You're in the same state as I am. Yeah, the COVID, they have eviction moratoriums, rent freezes, all these new regulations got put onto landlords and property owners, and we've I don't know if I think I'm sure some operators are the fact that they can't raise rents, and now it's going on 2.5 years now. I think that's impacting, obviously having an effect, and more owners have to go out of pocket to keep paying the bills.
Interesting. And then earlier you were talking about, how operators, social media is very powerful, and how all these operators, they just use the social media portals to advertise themselves or put themselves out there. Hey, we are doing this great, this and that. Well, I'm going to talk about from an investor perspective, how can technology be leveraged to improve their investing decisions?
Their investment decisions.
Yeah, especially in today's market, because there's so much gimmick and then so much information out there. It's very hard for an investor to select the right operator or the right market. It's like too much information download right there.
Right. I think, knowing the operator helps. And looking, if you're an investor trying to find a good operator, I would look at the debt ratio. People, like I mentioned earlier, people may be learning a hard lesson right now, but in the past 3 or 4 years, when the markets boom, and if you've seen multiple cycles, yeah, everybody starts out maybe relatively conservatively. Maybe you get into the investing business, the multifamily investing or real estate investing, and you think like 75% or 60% is a good rate, but then you get successful. You have these super success. Year after year, you can get a little more aggressive or be tempted to, and then pushing that debt further, and then maybe even getting into bridge territory. And I know pre-COVID and even right after COVID, there was a lot of operators using bridge on almost every deal. And when the market's favorable, it could work wonders for returns, but if the market turns, you could be in a bit of trouble.
Yeah, it could be hard. But the thing is, a lot of people are comparing today's market with 2008, like we were talking earlier, But I don't believe that is 100% true. I'm not sure what you're thinking, because we have learned from every experience we learn. That's the basic norm for human beings, right? Because we got the brain, we are smart. Every time we experience something, we learn something from that. So I just feel like from the 2008 crisis, we have learned some lessons. And I wanted to hear from you. I mean, what is applicable from those lessons in today's market?
Yes. I think, let's see, I think in 2008, one of the big one of the big issues was that they created these new loan products. And I think it goes back to that there was I think 2008 kind of kicked off with a couple things. It was they deregulated, and I think it was maybe 10 years prior to 2008 actually happening. And they also allowed American, United States, U.S. Debt, real estate mortgage debt was really attractive around the world. It was seen as very safe. So, banks kind of lost their way, and these debt vehicles were so profitable, a lot of the rest of the world wanted them, that it was really profitable for banks just to make as many loans as they can. And you probably remember this, but remember, like first, they opened up subprime loans. That was not a thing prior to 2008. It didn't exist. There was always like 40% of the market that just couldn't get loans, home loans. It seems maybe fascinating now that was the case, but there was a time when most, not quite most, but 40% of home buyers could not get a loan. But then, in order to sell these products around the world, they relaxed the standards. And then you probably remember, Vicky, that they kept relaxing it. It became like, okay, you don't really need to show your W-2s to us. And you could just tell me you have a job. You don't have to have proof of job or income. So there was like, what were they? They were called like NOLO loans or something. No stated income, no job necessary. So those were just a catastrophe that was inevitable. Like there was trillions of dollars in these bad loans, and they got packaged and shipped off to around the world. And a lot of it was managed by those big Wall Street banks. And, that obviously we all watched that when they all collapsed because there was so much bad debt.
I think that's the reason maybe you think we are in this situation now, because it's kind of a ripple effect, right? Take a little bit time.
Yeah, I think we saw, I feel like Silicon Valley Bank, Credit Suisse, some of the victims that happened now, maybe there was something that seemed reckless and really grossly irresponsible in 2008 with the way that banks and lenders, they were willing to make bad loans, and knowingly. And part of the reason they did that, because they knew that this bad loan that each bad loan that they made would only be on their books for maybe a month. And then they would package that up to Wall Street firms, and then they'd send those as securities around the world, and investors bought them up. But they were all terrible loans because they were all like ticking time bombs. And so when all those I'm sure you remember the waves of foreclosures, because these people that got loans, they couldn't pay their loans. And so there were whole communities. I think there was like parts of LA where the entire, for like a mile, like every house was under foreclosure, like in these new developments.
That's true. And everybody's kind of talking about the creative financing these days, and you might have seen that too, right? So they are coming up with different ways of getting this more creative on the lending side or the financing side. Have you seen something like that? Or can you share something in your area that you have seen?
Like ways to maneuver around, the obviously super high interest rates. We're doing a deal right now that and during a time like this, we're all kind of looking like how can we navigate this current real estate market effectively with these high interest rates that we're all dealing with. And one of my strategies is, there's, to take a step back, as you probably know, there's two huge demographics right now. There's the baby boomers, who is the largest demographic in US history. And now like their offspring, which is the millennials, has now surpassed the baby boomers. So we've got two giant demographics. One of them is all going into retirement, the baby boomers, and the millennials are entering their home buying years. So that's a long-winded way to get to, like, I think a strategy that you could use now is and that I think about is like, look for post-debt investors. And what I mean by that is like, look for those baby boomers who are maybe in their 70s, 80s. They don't want debt. They have properties and investment properties that are free and clear. And you could go to them, and that's the buyer, that's the seller that you want to buy off of, because they have no debt. In normal times, most of the people you buy from have a debt, have a loan that's due. And so they're limited on what they can do. But I think in today's world, you can buy, you have some opportunity to buy off of a seller who doesn't need or want debt. And some of them, the property that we're buying right now is the seller has owned it for 40 years. There's no debt on it. And he's tired, and he's a self-manager. And so, he's very willing. It's very appealing to him to sell the property and to provide debt. And he's providing us with 2%, a 2% loan for 3 years, which is phenomenal when rates are as high as they are. And he's happy. He's getting some cash flow. He's getting everything he wants. He's getting cash flow and no more headaches of self-managing. And I think there's millions of those sellers out there if you can connect with them.
Like we'll find them so they can do the seller financing. I think that's a really good one too. But what do you see the future of the multifamily investing, for the next few years now? And then I think, like you were talking about the generational change, or the experience for the new generation is totally different, because today's generation, and you're in the writing world, you write for Family Guy, and you are way ahead of the game, way ahead of most of the people, the way they are thinking. Experiential generation, that's what I call them. So that's all these companies popping up, here, they're like Uber, right, and then Dashdoor or whatever. So they don't want to buy properties, or they don't want to hoard like our generation was. We're like more into hoarding, buy a big house, buy a big car, all that. So, but they wanted to experience life, and they wanted to maybe rent more, or maybe hire a cab versus buying a car. So what is your perspective on that? You think it's going to change the dynamics for the investors going forward in the future for the next few years?
I would, I'm far from an expert on this, but I would think that as they get a little bit older, or start to have families, they'll recognize the value of an appreciating asset, which homeownership brings. I know right now and I honestly didn't read the economy that way at first, is like, why is there such a large demographic that's still renting into their, that have good incomes, but are renters by choice? And I think, there is an expedience and a convenience of not having that. But I wonder if long term, at some point, they're going to want to settle into a property that's gonna increase in value if they become more, investment focused, as most people do as they get older.
Yeah, I'm pretty sure. I think they're investors. They like to invest, but at the same time, they are like more experience oriented. See, that's the reason all this. And then when I see all these companies popping up, like Uber or Dashdor or multiple
Right.
companies, it's like kind of a share. It's like sharing is caring kind of thing. It's like share where everything is being shared. So I just wonder sometimes, what it's going to look like
I
5 years
know.
from now. So maybe it's going to have more opportunity for the people to invest in multifamily because if more people are renting, we need more housing on that side versus single family homes. That could be like a really good opportunity right there. But again,
Yeah.
it's like all depends, I think different thinking, different process of doing things. But anyways, we are out of time and I love to continue this conversation. But at this point, I wanted to ask you one golden nugget for my audience.
I think if you're a real estate investor, maybe you consider that strategy, the strategy that I mentioned of look for post debt sellers in today's environment as a way to navigate it. And what other gold nugget? Yeah, don't take it too seriously. I feel like a lot of I'm in two rooms on almost every given day. I'm in the Family Guy writers room, and I'm in with my team, my real estate team. And sometimes I often, you get stressed out, and I go to the Family Guy room, and I realize, like, oh yeah, it's this is important. Like, it's important for your health, for your mental well-being. You gotta laugh. And I think that's one of the gifts of that show, is that you go there every day and you make fun of other people and they make fun of you, and nobody really takes anyone or themselves that seriously. And it's healthy.
I love that golden nugget. Don't be serious. It's just life, live it. Have fun, because life is all about having fun, and don't forget to live.
Right.
Because if you're chasing money and then chasing work, or I don't know, whatever you're after, you're missing out on living. So don't be serious.
Yep.
Love that. So this brings us to a rapid fire round. I'm going to ask you 5 questions. You have to answer in one word with one sentence only. Are you ready?
In one sentence only. Okay. I'm terrible on my feet, but I'll try.
One word or one sentence. Okay. Let's try how good you are. You can do it. What is the one most important thing that you have learned in your life, and how did it change your life after learning it?
What is the most important thing I've learned in my life? Letting go.
Yeah, that's the best. What is the best book that you have read or recommend to my audience?
Best book that I have read. Catcher in the Rye.
Oh, that's a good one. In one word, what does life mean to you?
Community.
I like that. What is your biggest passion?
Running.
If you could turn back in time and talk to your younger self, what would you tell yourself and why?
Go for it. I would tell him, go for it, because you only live once. That's the juice in life, is don't take yourself seriously as part of that, because I think the fear and if you don't take yourself that seriously, I feel like I don't take myself seriously, and as a result, I try things and I'm happy to fail. And I think I succeed because I fail.
I love that.
Everybody's got to be ready to fall on their face.
That's so true. I like that. I'm in the same boat as well. So, Mark, how can people reach out to you?
You can, let's see, my company is Quantum Capital. You could come check out our website. And yeah, you could shoot me an email if you'd like. It's my full name, at me.com. Yeah, reach out. Love to meet you.
All right. Thanks for being on my show today, Mark. I really enjoyed that.
Thanks for having me. It was great. It was awesome.